back to the NEOS Monthly Income Podcast. I'm Tom Lydon, and as always, I'm joined by Garrett Paolella and Troy Cates, the founders of NEOS. Gentlemen, welcome. Happy summer.
Hey, Tom. Great to see you.
Good to see you, Tom.
Great seeing you too. Are you getting your Factor 50 out, new bathing suits? Are you ready for the summer?
I got the SPF 75 for you, so whenever you need it, just let me know.
All right.
A couple of umbrellas. We'll take care of you, Tom.
Thank you, guys. I appreciate you always have my back. Hey, last episode was awesome. We talked about NAV erosion. We also talked about, investors are seeking that high monthly income, but they also have to evaluate total return potential. What do you think, Troy, were some of the big takeaways from the last episode?
I think, on a high level, it's really good to understand what the difference is between understanding what NAV erosion is, what a sell-off in the underlying reference asset means versus a fund that might over distribute and actually have NAV erosion. So I think it's important to understand that when people are looking and educating themselves on products in this space and what they're looking at and what their goals are, to understand that NAV erosion can happen in certain funds that are possibly over distributing, as we talked about in the previous episode. But it's important to differentiate that between what the underlying reference asset is doing, say the S&P 500 or the NASDAQ 100 or whatever it might be, as that's selling off, you're still long all those equities inside the fund. But then when it does move higher, like we've seen in the past 2 months, and we've seen this great, tremendous rally in the equity markets. And the idea is, how can you capture a lot of that upside while still providing the fund with, a level of income and distributions on a monthly basis? So it's really important to kind of understand all of that and, give yourself some guidelines as you're investing your own money.
Garrett, do you think investors and advisors are getting smarter? It seems like they're digging in and they're doing the work.
Yeah, absolutely. I mean, we've been doing this coming on almost 2 decades, and every year we're more and more impressed with the level of understanding in these types of products, or just more, alternative or complex products as a whole. I think the ability for online resources and education, has been a big part, but also, investors managing some of their own money as well, whether that be the advisors or the end customers, right, are just becoming more financially savvy with understanding what their advisors are educating them on or talking to them about, or even the smaller sizes of the accounts that they're managing. Even if they do have an advisor that has the bulk of it, they're spending the time to really understand what a product is and how it's going to perform in their portfolio. So it's just great to see the level of education and understanding is, I think, really helpful for all investors for their own financial, well-being.
Well, there's been a lot going on in the markets. I mean, huge equity performance the last couple of months. So Garrett, have advisors been staying the course, and what are they thinking? You're talking to advisors all the time, and in the last 4 months, there's been a lot of volatility. What are they thinking?
Yeah, I think what another great thing to see is that we're hearing from a lot of advisors and investors they are staying the course. They're not getting scared with, quick geopolitical unknowns that are coming. This administration, as we know from its previous, 4-year term, right, is all about instantaneous change and shock, right? And so we've seen that over the last, 2 years or so, and we'll probably continue to see it. What we're really talking and understanding and seeing is investors are building those durable portfolios, and they are focusing a bit more on the long term, right? What are the more structural components of a client's portfolios, asset allocation? How do they build, again, a term I love to use all the time is durability, so that when you do have these times where you end up in a February and March where we've seen, north of a 10% sell-off over 2 months, and everyone's starting to get concerned what's going on geopolitically, interest rates, Fed chair change, a lot going on. But then very quickly, you see now a plus 30% rally in the NASDAQ, from the lows of March. And so when you're building portfolios, you got to stay invested, and you got to think about what your financial needs are and what risk you're comfortable with. And I think we've really seen that with a lot of the conversations with investors and those advisors, is staying the course, building the portfolio that keeps you in that course and stable. I think that comes back to also a lot of that education we were just talking about. The more educated investors are, the less potential concern they can be about these changes on more short-term thinking. Let me build the right portfolio, understand I always have a pocket of an allocation that keeps me going, and you can ride out these, type of, significant volatility shocks or unknowns.
And Troy, not just staying the course, but you've got real evidence that not only advisors, but self-directed investors are buying more than one NEOS ETF. Can you touch on that?
Yeah, we talk to a lot of advisors that are looking And they might come to us because they have an interest in one of, say, our larger ETFs and a SPYI, a QQQI. And then they kind of, we introduce them to the entire suite, and they realize that, yes, they can possibly earn some income and have a distribution off of gold or a real estate portfolio or maybe one of the cryptocurrencies. So it's really introducing them and educating them on what we have to offer. There's 19 ETFs in our suite, looking to grow that more this year. So really looking at ourselves as a solutions provider. When an advisor or even an individual starts to learn about the NEOS ETF suite, they could start to build their portfolio and help them find whatever that income goal is, whatever that overall asset allocation they're looking to kind of build. They could hopefully do it with some of our products. And we've seen that more and more, where we hear from an advisor, I started out with this ETF, but now I have 4 or 5, 10 of your ETFs in some of my clients' portfolios.
Yeah, it's great. Okay. So, Garrett, we talked a little bit about the markets, but man, it seemed just 4 months ago, people were concerned about markets. We had a decent pullback and then things reversed. We want to talk not only about that, but how did the NEOS lineup do during that period of time? Everything from the new boosted series to maybe some more conservative fixed income products like CSHI and BNDI. Overall, give us kind of a snapshot on how they might have performed.
Let's start with the boosted first. So
Yeah.
I think as we've been talking about, we wanted to bring out a what we call a boosted series, meaning you're using leverage as a part of the portfolio to seek additional total return and enhancement of the overall monthly distributions. And so if you think about our S&P 500 high income ETF SPYI, right, that's seeking to give you exposure to the S&P, slightly lower volatility, and going to seek that kind of distribution rate that falls generally within the 10 to 12% range. Well, the NEOS S&P 500 boosted high income SPI is really looking to add leverage to the cover call strategy. And so I think as most investors have engaged with us, they realize we have a hedged product version, we have a high income version. Well, now we have the boosted, and that's going to seek to give you additional total return because you're utilizing leverage, right? So that means additional downside risk as well. You got to be really knowledgeable and look at what the risk profile is of any investment you're in. But these having leverage, you want to understand the components of what your total return and upside capture is, but also your downside. However, we're really excited that we had brought those products out in February and basically led right into what we saw as a 2-month sell-off in the equity markets. And so whether that was the XSPI or our NEOS NASDAQ 100 boosted high income, which is XQQQI, those really, they did participate in the sell-off, as expected, as we saw those underlying indices sell off. But I think what's unique, and people are always talking about at cover calls, is what's that upside capture when the market does come back? And we've been very impressed with the overall performance and upside that those boosted series have in relative to those underlying long only, just NASDAQ 100 and S&P 500, right? And so I think we're giving now one more degree of optionality, I guess pun intended, to investors to choose, right, what is the risk or total return and income they're looking to seek, by now having a boosted version that participates in more of that underlying reference asset, both on obviously the upside, but also the downside. And then you have the core version that can give you that volatility mitigation. And then, of course, a hedged version that's going to offer a lot more downside protection, in those types of investors looking to reduce risk in it. So I think as we're excited over those last 4 months of the product, it gives another avenue for investors to really construct a portfolio that fits their estate planning goals and risk tolerances the right way.
So, Troy, talk a little bit more, go dig a little deeper in the options framework and how that might differ from traditional covered call strategies. And in addition, what Garrett talked about with the leverage aspect of it, yes, on the equity side, but also there's a positive benefit as far as the income.
Yeah, so the way we've structured these products is to not only give you, as Garrett walked through, that long leverage in the boosted series, but to give you additional income on top of that because we're writing additional calls. So if, for example, in XQQI, we're looking at QQQI where we're, say, 60% covered on the overall notional of the portfolio with the short calls, we're going to carry that over to XQQI. And what we're doing there is when we add that leverage, we're still covering that 60% of the additional leverage. So we're bringing in more dollars, more premium from writing those short calls, which we then distribute out in the monthly distribution. So while you're getting that longer leverage when the market moves higher. We also have to think about what that looks like on the downside because you have that long leverage. It works against you when the markets go south. And that's what Garrett was walking through. We kind of brought these products out in early February, very excited to bring out this product suite. But then we went into this kind of 7, 8 week sell off where you saw how that long leverage affects the portfolio in a negative way versus, say, the core product, QQQI in this example. But when the market does move higher, you have that boosted or levered version. You're going to potentially pick up what you missed out on the downside. So for us, it's all about education. It's understanding when you're buying a lever product, whether it's one of ours or any product, what that means for your risk tolerance, what that means for your overall exposure, and what that could potentially mean in our case for the income that's coming into the portfolio and distributed out.
Garrett, the distribution has been fairly consistent though through these products, through this period of volatility as well. And also, what surprised you most as far as investor adoption? I mean, we've seen some pretty good pickup and adoption within these strategies in a short period of time.
Yeah, I mean, listen, we're always pleased and impressed with our client base and all of our partners that utilize products that fit within, their framework. And I think that's really the test of why is the adoption picked up is you're giving another solution to where investors have talked to us most about their portfolios, right? They, by doing this for almost 2 decades, right, core covered call products have always had their area within the portfolio. And over the years, people had talked to us about, hey, can you give me more of a measure of downside protection? Right, in my allocation, because I have some maybe older clients or more risk adverse clients that don't need quite as much income, but would love if you could hedge some of that market risk out, which is really why many years ago we built our hedged equity suite and products is for those investors. Now listening to everybody over, the last number of months and years, they've said, I would love to have more risk, like more exposure, and take a higher octane allocation to kind of match more of just what like the equity markets are going to do, right? As opposed to the core cover calls that have lower volatility that they exhiberate. I want to take that volatility back and be long more of the upside of the market. And so we've been very impressed with, of course, the adoption of the products, but also very pleased that, the products have performed exactly as our rules and, our investment process suggests. And so it's just giving that one next additional allocation opportunity for investors to be picking where they want to be or how they choose multiple products to build really their customized approach.
Speaking of high octane, XBCI, the boosted Bitcoin high income ETF, has also some interesting characteristics that fit well within the boosted series. Just high level, touch base on that if you would.
Sure. So if you think about how BTCI is constructed and how we're getting long exposure to Bitcoin, whether it's through some of the ETPs or synthetically through a put call combo on the index options, we're doing that same structure in the boosted version. So it looks very similar. We're just adding additional long leverage with that put call combo, that synthetic long, using those SIBO Bitcoin index options. For us, when you see those, again, those down moves in Bitcoin or in BTCI, it's going to be amplified and you're going to see a larger levered move to the downside in Bitcoin. But when it moves higher, you're also going to see that added leverage work for you when you're long the product. So there's, of course, a lot of volatility within Bitcoin itself, which gives BTCI and XBCI an opportunity to harvest and bring in a lot of premium off that volatility of the options market and distribute that out. But with that volatility comes a lot of swings within the market. So you have to understand if you're buying, whether it's a BTCI, you have to understand that Bitcoin volatility and what that might look like for you. But also if you're going to take the levered version of that, what that might look on the downside, what that risk is like, but also on the upside. So it's different for everybody. But for us, we wanted to have these different portfolios out there so people can build their own portfolios and understand what's in the portfolio and understand what risks they're taking.
The good news continues on the other end of the spectrum. Some of the more traditional products like CSHI, the Enhanced Income 1 to 3 month T-bill ETF, and then BNDI, which is the Enhanced Income Aggregate Bond ETF. Great news. Top 2% in performers year to date in their Morningstar categories. Talk a little bit about those strategies.
Yeah, these tend to sometimes not be the most talked about just because it's fixed income relative to equities and equity volatility. But why we've been really impressed with these products, right? CSHI and BNDI were two of our first three products that we launched in August of 2022. And, we've seen really strong performance overall through a variety of market cycles. But of course, as you had just mentioned, top performers within their categories. It's because I think when we think about the products, what we're building in these two ETFs are exposures to, in CSHI, 1 to 3 month treasury bills. So laddered, very similar to what you'd see in a traditional, just long only simple 1 to 3 month treasury bill exposure fund. And so we own those underlying treasury bills and we roll them methodically in order to maintain that exposure and duration. For BNDI, we're long exposure through two ETFs, BND and AGG, which gives you a very diversified exposure to core aggregate bond market. I mean, we're talking north of 15,000 bonds sit within each of those ETFs. And on a weekly basis, we're really instituting an S&P 500 put spread strategy. And why are we doing that is the equities and fixed income tend to have inverse correlations to one another. Not always, right? You could have times where all correlations and asset classes, go to one, but we're looking to match that underlying option overlay with the general risk profile of your fixed income. So seeking to keep a very similar standard deviation, so meaning kind of volatility and risk level within the portfolio, but leveraging a tax efficient option income strategy because you're using those 1256 options that we've talked about before. So index options that can get a tax treatment of 60% long-term capital gains and 40% short-term. And ultimately, you're looking to just enhance the income. And this is like a big component of these is it's not high income for a reason, it's enhanced. When volatility is there within the options market, you could seek anywhere from, in CSHI, around 1 to 1.5% of additional options income a year above what you're earning off of your treasury bills. In BNDI, because aggregate bonds have higher volatility profile, that could seek more in the upwards port of 2 to 2.5%. If volatility gets really low, think about the ability, you're not going to change the option strategy. You want to keep mitigating risk. So your income could just come down in very low volatility times, right? Which is what you should be doing. This is fixed income. So you want to enhance the income. You don't want to be focusing on just in income output. And you could be more in the, say, 75 basis point range for CSHI, or 1% in BNDI, because low volatility, that's what you're going to get paid. That can be the enhancement from the options. And so we really like these products because, as we've seen, performed really well relative to obviously the performance you're referencing, but is filling the need to enhancing income in a tax efficient way across fixed income. And as over the last 2 years, we have seen a reduction in interest rates from all-time highs, you're able to really help fit the additional income component need. And I would say one great example of that is talking with advisors. Sometimes they view this as, well, I would normally stretch to high yield because I need to get the income, but I could sit in your core aggregate bond, take less duration risk and have lower credit risks as well, but get almost the same commensurate risk that I'm getting in your high yield, or go from a core aggregate bond into a 1 to 3 month treasury bill to be able to get that. So there's different ways to think about the risk allocation with these products and not having just to take your fixed income, traditional risks in order to kind of enhance that total return and, tax efficient distributions.
And Garrett, that's a big deal. It's a big deal for investors, big deal for advisors, controlling risk and being able to downshift a little bit there and then maintain that high income stream. It's awesome. Troy, this has been a great wrap up, but before we go, as always, you guys never rest. You're never sitting on your hands. You've always got something brewing. You've got a couple new filings, and I know there's not a ton you can talk about it publicly, but maybe just an outline of what might be coming.
Sure. So we filed for 2 additional funds to add on to the suite. So first one in our alternatives sleeve, we're bringing out a NEOS Silver High Income ETF. So very excited about that to add on to, say, gold and the other alternatives we have in that portfolio. So really excited to bring that product out. Gives you exposure to long silver with a component of income and distributions. We're hoping to get these out sometime midsummer, possibly. So really excited about that one. And then the other one is another boosted ETF. So looking at IWMI, our Russell 2000 high income ETF, we're bringing out a boosted version of that. And that we're really excited about. We've seen not only great performance in the Russell 2000 this year and our product, IWMI, but we're really excited as we've seen the growth in that one to bring out a boosted version and offer that to clients.
As the Neo Silver Fox, are you going to be the face of that silver ETF?
Well, we know it's not going to be you, Tom.
Guys, great update. I really enjoy these every month. So thank you and continued success. We'll see you at the beach.
Sounds good. Thanks,
Thanks,
Tom.
Tom.
Appreciate you being the MC.